Hey everybody, I hope everyone is doing well and had a good day. This is going to be a brief recap of the Emini 5-minute chart for Monday, April 7th, 2025. And this was a really interesting day, especially bar 9 I want to talk a little bit about. But before I do, let's take a look at the Globex. We had a big gap down going into the day. Let's look at the Globex, and I usually look at the 15-minute chart, and we will, but I also want to look at the 5-minute chart. I want to talk about the first bar from the Globex session here. So here's Friday's close, and then the first bar of the Globex session. And let me see, this bar was 175 points on the 5-minute chart. I think that's the biggest Globex chart bar I've ever seen. Actually, I know it is. I'm wondering if it's the biggest Globex bar that the stock market's ever seen. So I thought that was really interesting, but you can see after the big gap down and the huge bear bar really went sideways. So we had a trading range going into today's open, mostly sideways. Maybe we have to test the lows. We're at the highs, so maybe we have to go lower, but we'll see. It's probably close to 50-50. And then for the 5-minute chart today, also I want to say one thing. The volatility obviously is pretty huge here with the size of the bars that we have. And I want to remind everyone that if you can trade the SPY, that's great. I think you probably should be trading the SPY unless you and your account can handle the amount of risk that the E-mini or even the micro E-mini is currently under these volatility circumstances. It's perfectly okay to just watch and not actually trade if your account or if you cannot emotionally handle the risk that is required. Obviously, these bars are enormous, but the size of the bar actually has nothing to do with the price action. If you took away the price axis and the time axis for that matter, Al talks about it all the time, price action is fractal. It doesn't matter the time frame, it doesn't matter market. They behave consistently over any market on any time frame, and there's no way to know how big these bars are unless you have the price axis. And so the geometry of price action remains consistent no matter the size of the bars. With all that said, before I get into it, bar 9 was 233.75 points. And just like that Globex 5-minute bar, I think this is the biggest 5-minute candle in the history of the stock market. And I'm not totally sure, but I've been trading. I've seen this kind of volatility during the pandemic in 2020. There were trading halts and it was kind of similar volatility, but I don't recall ever seeing a bar this massive. So bar 9 was really interesting bar to see. But even if there's no way to know that it's 233 points unless you have the price axis. This just looks like any other chart. You don't know how big the bars are. It's just a trading range day. So big gap down, and look at the first 3 bars of the day. Bar 1, tail below. Bar 2, even bigger tail. Bar 3, big tail. Bars 1 through 3 is a channel on a smaller time frame with buyers below each bar. And channels evolve into trading ranges. And on a smaller time frame, this is probably more clearly a wedge. And it's also important to know a couple of things. One, bar 1 remains the high or the low of the day about 20% of the time in general. So it's a low probability event for bar 1 to remain the high of the day at this point on bar 3. Also, the first move of any bar usually is not the final move of the bar. And by that, I mean most bars have tails. Just look at any chart and you can see on the daily chart most bars, even if they're small, they have upper and lower tails. And in this case, we open and sell off for a few bars. But is it likely that today opens on its high and trends down for the rest of the day? In general, it's really not all that likely. The first move usually becomes an upper or lower tail on the daily chart. And that's what we had here. So bars 1 through 3, we have 3 legs down, and then a bull reversal, bar 4. Bar 4 is a breakout bar, and bar 5 is a follow-through bar. Bars 4 and 5 compared to 1 through 3, they're bigger, they're stronger, the bodies are bigger, there's less overlap, smaller tails. 4 and 5 is a stronger breakout. And while 1 through 3 might get a second leg, there might be sellers above. It's not an ideal stop order above 3. Bars 4 and 5 are a much stronger breakout and follow through. 4 and 5 will probably get a second leg. Traders buy the close of 5, and we get more follow through on 6. The market's in a never-ending cycle of expansion and contraction. 4 through 6, we have expansion. It's a bull breakout. 7 and 8 is contraction. It's a 2-bar trading range. When the trading range is 2 bars, you call it a pullback. You can call it a trading range. Bar 7, bar 8, they're each 1-bar trading ranges. But when the trading range is minor, in other words, you expect the trend before it to continue, you typically call it a pullback. When the pullback grows to 20 or more bars, breakout direction becomes more like 50-50. Then you might call it a trading range. But at this point, this range contraction is a pullback. So bull breakout, pullback, and then bar 9, a huge second leg up. And this is all a micro channel from bar 3 all the way to bar 10. 9, such a huge bar, it's probably going to get a second leg. But the problem with 9, and again, this has nothing to do with its range in terms of points. It's the relative range of the bar. The bar is big. And when you have a big bar, you have big risk. If you're buying the close of bar 9, 1 times your risk is all the way up here. And you can see what happened on bar 10. We rallied, but at some point during the bar, we began to hesitate and sell off, and it became a reversal bar, and bears controlled the second half of the bar, and it closed near its low, huge tail on top. So if you buy the close of 9, you're probably disappointed with 10, because if your stop is all the way down here, 1 times your risk is up here, you need momentum, and you look to the left. And this also has to do with the Globex chart. Here's the 5-minute chart. Maybe I'll zoom out, use the 15. So here's that trading range I was talking about. And this is basically bar 9 on the 5-minute. Big bull breakout bar, good for the bulls. We're testing the higher time frame, 60-minute EMA, and then we have bars to the left still. So good looking breakout so far, but the bulls need follow through. And you can see the next bar. The momentum disappeared. Traders took profits. Bulls who bought lower sold out of longs. Bears see the price as expensive, and they're looking to sell. So it's a problem that bar 10 was not good momentum for the bulls, because if you're buying here, are you buying value or are you buying momentum? Well, the average price is way down here, so you know you're not buying value. Bulls buying down here are buying value, buying below the average price. But up here, we're way above the average price. So the traders who bought lower looking to take profits. And bar 9's a surprise. If you're a bull, it's a gift bar. If you bought anywhere down here, you get bar 9, you might just take profits on the close of 9 or above 9, somewhere up here, especially when you get bar 10, disappointing follow through. So what happens on 11? We get a sell vacuum, test of support. Nobody's willing to buy up here. Bulls who bought lower, taking profits. Bears, they see or they sense the lack of momentum, and they know that we're above the average price. So the bears know the bulls need momentum, and we're expensive. So bears start selling aggressively, bulls start selling out of longs, and the price is forced to go lower to find buyers. Big up, big down, big confusion. It's a trading range. Both sides expected to get second legs. Now that that's the case, there's probably going to be more two-sided trading, and the probability will not be all that good for either side. So at this point, traders are looking to buy low and sell high. 11 is a strong bar with follow through. The odds are it's going to get a second leg down, but because it's big up, big down, the second leg might be late, it might be delayed, and the pullback might be deep. 13 was a pullback. We went above the high of bar 12. And because of that, we have one pullback, 2 legs down, and we're testing support. Remember I talked about this 2-bar pullback, and I'm making a motion with my mouse. I'm not sure if you can see, but I'm trying to show that bar 8 is actually an inside bar. This is a 2 or 3 bar triangle on the 5-minute chart, more clear on a smaller time frame. What do we know about triangles? Triangles are, or contracting triangles in this case, it's a type of trading range, and it's an area of agreement, at least briefly. And we know that most breakouts of trading ranges fail, and we know that trading ranges are areas of agreement. Bulls and bears taking trades here. Bar 9 traps a bunch of traders. Bulls who did not buy here missed a really big rally. And if you're a bear and you sold anywhere down here, you got trapped into a losing trade. Naturally, this creates support below. So this is why bar 9 is probably going to get a second leg up, because of trapped traders down here. So you can see where the market tested down on bar 14 in this area. We came back to close to the apex of this triangle, and sure enough, we found support and the market bounced, at least temporarily. A couple legs down in a trading range to support, you can expect at least a bounce, and then 15, a really strong bull reversal bar. It's a trend bar reversing bar 14. You can call it a 2-bar reversal, but like I said, 2 legs down to support after a strong rally in a trading range. 15 will probably get a second leg up. 15, then we paused. We had range contraction again, or compression on 16. 15 is a good trend bar. 16 is a trading range bar, basically a doji. And then 17, expansion again, big, small, big. 3-bar micro channel, strong enough for a second leg, but same problem as over here. Now it's big down, big up, and it's still a trading range. And now we're testing higher in the range where there's probably resistance, because bar 11 traps traders above. So even though the rally looks decent, you may have a deep pullback, and the second leg might be delayed because of the context. Big up, big down, big up. We have a pullback on 19 in an attempt at trend resumption for the bulls, but obviously in this context, I say trend resumption, it's probably a bull leg in a trading range. And what happened on 18, by the closed traders on 17, trapped on 18, they used bar 19 to exit at break even, and bar 20, strong enough bear bar for a second leg down. And in this case, we got follow through right back down to the bottom of this range. Now what happened down here? Remember bar 15, strong bull bar traps traders, second leg likely. What that means, the way I see it, 14, bear trend bar, sell the closed bears, get trapped on 15. And traders who did not buy down here, if you're maybe bullish, looking to buy, but never got a signal, now you missed out on the rally 15 through 17. You're trapped out of a winning trade. Bears who sold, trapped into a losing trade. Both traders looking to buy when the market comes back to the support and capture another leg up. So 20 and 21 racing down, but look to the left, and we're still within this rally. So this might simply be a sell vacuum test of support. And you can see we tested the support, bears unable to break out below the support, and we reversed back up for at least a scalp. But you can see what happened here. Bar 20 traps traders, breakout point. You can say the bar 19 low, 21 tested it, and we came close to it again here, but sold off. And 25 through 27 is similar to 15 through 17. Not quite, but sort of big, small, big, more compression on 26. You can see it has two legs up. One, pullback. Two, testing near resistance. And you can see the market is taking the shape of maybe a triangle. There might be a bear trend line here. High, lower high, lower high. Not quite getting higher lows, but the range is certainly compressing. And it's becoming a tighter range, even though the bars are big. Remember, the actual range of the bars isn't all that important. Of course, you have to adjust your position size and scale down so that you can risk the appropriate amount for your account size. But to me, it doesn't matter that these bars are 42 points. It's becoming a tight trading range and a triangle. So you can expect breakouts to fail, and it's a limit order market, so look to buy low and sell high. So 25 through 27, strong enough breakout. Second leg up likely, but the pullback may come all the way back down to maybe the 24 high. It's a bad signal bar. Bottom of the range, probably support here. The bears, they get a 3-4 bar micro channel. So now the bears probably will get a second leg, but they might get a deep pullback as well. And the sell zone is somewhere up here. You can see the reaction bouncing at that support level. This looks like a minor reversal. The bears are probably going to get a second leg down, and the bulls and bears may look to buy a little lower. But again, tight trading range environment here. 36, 37, breakout follow through, but now testing resistance near the top of the range, probably sellers somewhere up here in this area. There's no one exact line of resistance. It's just somewhere in this area I expect sellers. And similarly, somewhere down here, I expect buyers. The bears get their breakout, fairly deep pullback, second leg down. Now we have a late leg near the bottom of a trading range, probably support, like I said, somewhere down here. And look what 43 did. Back to the bottom of the range, testing support. Traders who bought the close 27 scaled in lower, nearly got out at break even on their first entry and with a profit on their later entries. But it looks like a fairly horizontal trading range. Breakout direction, probably close to 50-50. There might be a slight bullish bias because of the rally on the open. Looks like the rally was stronger than the sell-offs we've had. Bear bars getting bad follow-through and lots of overlap through here. The rally was pretty relentless and almost went straight up. And I still think we need a second leg up after this rally to maybe at least test this breakout point, the bar 10 low. It's a trading range. Breakout points and trading ranges usually get retested. And let me just speed it up here. So it's breakout mode at this point. I was talking about bar 43. Lines aren't perfect, but you can see the general shape of the triangle. Breakout mode 50-50, 45 breakout, follow through for the bulls. And after a pullback on 49, the bulls would get a second and a third leg up. But let's think about the context. We know already that the market tends to reverse after 2 or 3 legs, especially in a trading range. You have to be really cautious if you are long during a third leg up, but also support and resistance really important in a trading range. When those two things combine, You can find trading opportunities, but most importantly, you have to understand the market behavior when these things combine. So for example, here, maybe 45 through 48 resets the market cycle to some degree. Leg one breakout, pullback, now we have a spike, and we've begun the channel phase. And we channel, you can see the bars pulling back intra-bar, sellers above highs. This is a channel. And we're testing resistance, the bar 19 high in this case, near the top of the range. Deeper pullback, and then finally one more bar, a third leg up. 1, pullback, 2, pullback, 3. I'm simply counting spike breaks when a bar technically pulls back one tick below the low of the prior bar. So 49 falls below 48. Leg 1 terminated, begins leg 2, terminated by bar 56, and then leg 3 terminated by bar 60. 3 legs up, slightly higher high double top with 19, micro double top 55, 59, and then a bear breakout of bar 60. Pretty good context for at least a second leg down. And the process repeats the other way. Maybe 60 resets the count to some degree. We pull back, second leg, pull back, third leg down. Here's a breakout point. We broke out above it, did not retest it. Maybe 47 retested it. You can see finding support here, range getting compressed and tighter. Again, even though the bars are big today, to me this is a tight trade range and a limit order market. And trading breakouts becomes really difficult through here. And I think if you are going to trade breakouts through here, probably better to look to enter on deeper pullbacks. For example, bar 60, instead of selling the close of 60, you're at support, the moving average, and you're just barely breaking below 57. Maybe instead you sell the pullback, maybe the breakout point 59. Look to enter here to capture that second leg, similar to bar 73. Bull breakout, no follow through above this breakout point. But if you buy a deep pullback, maybe you capture a second leg and then just look to get to the close of 73. You can see 78, bar 78's reaction there. So that's it for this review. And I just want to remind everybody, these videos are just a supplement, and I really hope that they're helpful. But if anybody has not gone through the Brooks trading course or explored any of Ali Moin-Afshari's material on price action, I really urge everybody to check them out. I'm basically just a messenger, and I'm practicing the concepts myself. But to get to the source of all that, you can find more information on that in the description of this video. So that's going to be it. Thanks, everybody. I appreciate it, and I hope everyone has a good night.